Assalamu alaikum. Good afternoon, everyone. We'll just wait for another 1 minute to ensure that everybody joins the call. بسم الله الرحمن الرحيم. السلام عليكم ورحمة الله وبركاته. نرحب بكم في هذه الجلسة الحوارية لعرض أداء الشركة التشغيلي والمالي للربع الأول من هذه السنة 2026. وأعرف بنفسي صادق اللواتي، نائب المدير المالي التنفيذي ومدير شؤون المستثمرين بشركة أبراج لخدمات الطاقة. نشكر لكم حضوركم واهتمامكم بالمشاركة في هذه الجلسة النقاشية، ونحن على أتم الاستعداد للشرح والإجابة عن جميع استفساركم، وملتزمين بمبدأ الشفافية ومشاركتكم سير أعمال الشركة. وكذلك نحب أن نثمن دور وجهود بورصة مسقط للتنسيق لهذه الجلسة الحوارية ودعمها المتواصل لتسهيل التواصل بين الشركة والمستثمرين. الجلسة الحوارية مكونة من جزئين. الجزء الأول عبارة عن شريحة عرض لأداء الشركة، والذي سيقدمه الرئيس التنفيذي للعمليات والقائم بأعمال الرئيس التنفيذي لهذا اليوم الأخ زهران الكندي، والرئيس التنفيذي المالي الفاضل أوبيل رفيع. وفي الجزء الثاني سنقوم بفتح المجال لأسئلتكم ومداخلاتكم والإجابة عنها من خلال الفريق المتواجد معنا. العرض سيكون باللغة الإنجليزية لتواجد مستثمرين أجانب داخل وخارج السلطنة، ولكن فريق الإدارة على استعداد لأي استفسار أو توضيح باللغة العربية. الجلسة تكون مسجلة، وكذلك سيتم رفعها بعد الانتهاء في موقع الشركة وموقع بورصة مسقط. العرض المقدم هو لأغراض معلوماتية فقط، ولا يعد إلزام للتوقعات المستقبلية. So good afternoon, ladies and gentlemen, and welcome to ABRAJ's earnings call for the first quarter of 2026. Thanks to Muscat Stock Exchange for hosting today's call. Last week, we published our audited financial results for the quarter. These are available on MS6 portal as well as on our ABRAJ Investor Relations portal, the website. The presentation used during today's call will also be published to the MS6 portal and Investor Relations portal shortly after the session. As usual, I would like to draw your attention to the disclaimer statement, which I invite you to read at your convenience. Joining me on the call today are Abraj Chief Operating Officer, Mr. Zahran Al-Kindi, who is attending on our CEO's engineer, Saif Al-Hamhami, who is on a business trip and able to attend today. Also presenting our Chief Finance Officer, Mr. Ubail Ofe, and our Chief People Officer, Mr. Hilal Asiyabi, who will be available to assist during the Q&A session. The agenda for this session will cover financial and operational highlights for the first quarter of this year, backlogs and market share updates, utilization rates, financial performance. Our closing remarks will include update on the strategy, excluding execution and guidance. We will then open the floor for the Q&A session. With that, I will hand over to our CEO, Mr. Zahran Al-Kindi.
السلام عليكم ورحمة الله وبركاته. أهلا وسهلا جميعا. Good afternoon, everybody. Let me start by highlighting ABRAJ financial performance for the first quarter. this year. Alhamdulillah Rabbil Alameen, we began the year with a very strong footing with recent revenue and improved margins. For the quarter, we recorded a revenue of 36 million, represent 6% decline quarter on quarter. The decline mainly reflects rig move activity, some impact from the Kuwait operation. We have two rigs in Kuwait, they've been stacked under hot stacking rates due to the situation in Kuwait, and that's since 5th of March. And planned maintenance on one of the rigs. Despite this, our profitability improved. We delivered an EBITDA margin of 33%, which is 1.6% higher than the previous quarter. This improvement reflected a reflection of disciplined cost control and strong operation efficiency. Profit after tax increased by 20% quarter on quarter, reaching around 4.5 million Oman riyals compared to 3.7 million Oman riyals last quarter. This resulted earning per share of 5.79 paisa for this period. From a cash perspective, we remain strong. Operating cash flow amounting of 12.1 million, representing close to full cash conversion from EBITDA. During the quarter, we invested approximately 10 million Oman Riyal on CapEx, mainly related to deliver of a new built rigs as part of our growth strategy. I will leave our CFO, Hubert, to cover the financial in more details later on. For now, I would like to give some operation highlights. Alhamdulillah Rabbil Alameen, our operation in terms of rig utilization, we achieved almost 90% rig utilization. It's improved compared to last year. As a reminder to everyone, our average utilization last year was around 85%. It's also good to highlight that at the end of the quarter, we had 3 inactive rigs. One of those rigs commenced operation last week successfully, alhamdulillah. Another rig expected to start shortly, and the third one has mobilized and it is expected to start within a couple of weeks. Based on this progress, by end of Q3, somewhere we will have 100% utilization on the rigs. Another highlight in terms of client and customer satisfactions, we achieved around 91%, reflecting a strong client confidence on our service quality. In terms of NPT, non-productive time, we stay way below industry benchmark. We are around 1%. Another highlight, rig moves. We continue outperforming in our rig move. During this quarter, we successfully execute around 80 rig moves through the operation excellence. We saved a total of almost 900 hours. That is the target. That result into 400,000 Oman Riyal additional revenue from the rig move. In terms on health and safety, we continue to see improvement in our lost time incident frequency. We also obtained the certification of ISO 45001. The backlog. Our backlog continues strengthened following the record backlog of 880 million Oman Riyals reported last quarter. We achieved a new all-time high of almost 900 million Oman Riyal by the end of Q1. Over the last 4 quarters, backlog has increased nearly 20%. During the quarter, we consumed approximately 36 million, as you can see it in the bottom below left graph of a backlog through the revenue. This was more than offset by the new contract awarded, including the extension of our 4 Wave 2 rigs with video for 6 years each, contributing around 124 million Oman Riyal, and a cement surface award from OQEB, adding around 13 million Oman Riyal. Subsequently, the quarter end of announced a hydraulic fracturing contract with BDO with an estimated value of 120 million, which will be reflected in Q2 بإذن. As a result, we expected a backlog of almost 1 billion by the end of the second quarter. Turning to the market share, as you can see on the top graph, as of today, on the drilling rigs, we own around 26% market share. We expect our market share to increase slightly, reflecting the deployment of the new build rigs and the reflection on the stack rigs, for which we secured a contract in Q2. In fracturing services, we expect our market share to increase following the latest BDO contract, which will increase our scope and will also allow us to attend to the high-end and more complex wells. Similarly, on the cementing, we expect our market share to increase following OQEB award. Finally, we are proud to say our utilization continued to trend upward, and as mentioned earlier, we expect to reach full utilization by Q3. With that, I will hand it back to Robert to cover the financial performance in more details.
Thank you, Zaran, and good afternoon to everyone on the call. I will now walk you through key financial performance metrics for the quarter. So the first slide is showing the financial performance with some key metrics. We have revenue, EBITDA, profit after tax, and CapEx. And for each one of those metrics, we will look at year-on-year comparison and quarter-on-quarter comparison, which will be this current quarter, Q1, with the prior quarter, Q4 2025. So starting with the revenue on the top left graph, year-on-year performance shows a modest -2% decline, primarily due to lower rig move and fracturing activity, partially offset by additional active rig months. Quarter-on-quarter, as Zaran mentioned, revenue declined by 6%, also due to fewer rig moves, the impact on Kuwait rigs, and scheduled maintenance and upgrade on one of the rigs that happened during the quarter. We will cover these in more detail in the upcoming bridging slides. Moving to EBITDA on the top right corner, year-on-year, we have a year-on-year reduction of 4%, which is broadly in line with the revenue trends. However, quarter-on-quarter EBITDA declined by only 1% compared to a 6% decline on the top line, which is reflecting improved margin driven mainly by cost efficiencies. Profits after tax declined slightly year-on-year due to the timing difference in maintenance activities. And again, on a quarter-on-quarter basis, however, the profit increased by 20% from 3.7 million to 4.5 million, driven by higher rig activity, cost efficiencies, and also the absence of an impairment charge that we recognize in Q4 of 2025. Again, we will cover these in more detail in the upcoming bridging slides. Capital expenditure now, which is the bottom right corner. For the quarter, we spent 10.6 million, which is largely allocated to new build rigs. We have 8 new build rigs under construction, of which 7 are with PDO. We have 6 with the Wave 3, and then we have a 7-1. And then the last new rig build is with Wafra Joint Operation in Kuwait. Of the 8 rigs that are under construction, 5 represent net growth to the fleet, and 3 will replace rigs that are scheduled for retirement in the near future. Turning now to performance by segments. As you know, we have 2 segments. We have drilling and workover and well services and others. So in the drilling and workover segment, financial performance is highly sensitive to the number and the distance of the rig move. So year-on-year revenue remained broadly stable, while profit declined due to reduced rig move activity. Q-on-Q revenue declined from 33.1 to 31.6 million, reflecting change in rig move activity, notably due to weather condition in the last week of March. We had also maintenance downtime, where we had 1 rig that went for almost 60 days in planned out of service time, and also Kuwait-related impacts, which I will cover in more detail. Despite this, margins improved due to the higher rig activity and the absence of non-recurring impairment charges. The other segments, the well services and others, include fracturing, cementing, and revenue from our Infintech training center. These businesses operate largely on an on-call basis, I mean the fracking and the cementing, making the financial performance of that segment highly dependent to the job execution volume. Revenue declined quarter on quarter due to one sizable fracked job in Q4 that did not repeat in Q1. Encouragingly, profit margin improved year on year and quarter on quarter, supported by stronger cost control, particularly in equipment hire, logistic, fuel, and chemicals. Let me now walk you through the bridging analysis for the fourth quarter to the first quarter, starting with revenue. So starting with the revenue, as we said, we saw a quarter-on-quarter decline of about 6%, moving from 38.4 million to 36 million. The majority of this reduction was driven by lower rig move activity, largely due to adverse weather condition in late March that has temporarily stopped all rig move across the country. In addition, as I mentioned, one rig was taken out of service for planned inspection, recertification, and upgrade, which also reduced the revenue. We also experienced some impact on our rigs in Kuwait. As Zaran just mentioned, we have 2 rigs in Kuwait that are currently on the standby day rates. And we have some of the adjacent revenues, such as, the recharge and the catering, are also reduced accordingly. There were a few smaller positive and negative items during the quarter, but overall, these broadly offset each other. So again, revenue variance largely explained by lower rig move activity, one rig on a planned maintenance, and then a little bit of Kuwait-related impact due to geopolitical situation. Now, moving on to the profit after tax bridging. The same operational factors drove to a combined downside of approximately 1.1 million, which is basically the addition of the red bars. Again, this is coming from the rig move activity, the maintenance downtime that we had on one of the rig, and the impact of Kuwait. And this downside was partially offset by higher rig activity, including one rig that commenced a new contract during the quarter, as well as continuous improvements in our cost structure. In addition, we saw also better cost management in our frac service business, particularly in product and logistic, which delivered a modest but positive contribution to the bottom line. Overall, these factors explain the quarter-on-quarter movement in profit after tax. Now, finally, turning to cash, our opening cash position at the start of the quarter was 7.1 million, and we closed the quarter with 6.6, representing a 7% decrease Q on Q. The key operating drivers were the profit after tax and the non-cash items, such as depreciation, amortization, asset impairment, which were added back to the cash. On the investing side, as we mentioned, we had a capex of 10.6 million, mainly related to the new build capex program. To fund these, we drew 19 million of additional debt during the quarter from 3 commercial banks. At the same time, we repaid 4.9 million of loan plus lease liability. And we also paid 1.5 million in interest and bank charge. So for information, our weighted average cost of debt is around 5.5%. So in March, we also paid 13 million of dividend, which is equivalent to 16.88 Bayza per share, representing approximately 74% of our 2025 net profits. Finally, the remaining movements relate to income tax and other net items, which are mainly timing difference between accounting recognition and cash settlements. Now, let me turn on to cash, net debt and leverage. So at the end of March, our net debt was 110 million, comprising of 103 million of long-term debt, a fully drawn 10 million revolving facility, 3.5 million of lease liability, net of 6.5 million of cash. The net debt to EBITDA leverage ratio increased to 2.3 in Q1 from 1.9 in Q4, reflecting the ramp-up of our capex cycle. and we expect the leverage to continue increasing as we deploy additional debt-funded capital to support CapEx-driven growth. Despite this increase, leverage remained moderate and still provides continued headroom to support future growth opportunity. The bottom charts illustrate the net debt bridge from Q4 to Q1. So net debt increased from 95 million in Q4 to 110 million in Q1, driven by 14 million of net additional long-term debts, which was again 19 million of new drawdown, partially offset by 4.7 million of principal repayments. The short-term debt remained unchanged, while lease liabilities increased modestly. And then the cash declined by 0.5, which is basically reflecting 12.5 million of free cash flow to equity, offset by 13 million in dividend payments. The next slide, this will not conclude the financial update. Before I hand it back to Zaran for his update on strategy execution, let me just cover a few things on the guidance. So in the last quarter, we gave a guidance of revenue of 145 to 155. This guidance remained unchanged. The update that we are giving is in Q2 2026 for the second quarter. In the top line, we see a slight upside of between 0 to 5%. This is Q1 due to improved rig activities. Our guidance on EBITDA remained unchanged from low to mid 30 percentage points. And the guidance on the CapEx remained unchanged from 70 to 90 million Omani Rial, which is basically the ramp up of the CapEx program. With that, I will hand it over back to Zaran for his closing remark and update on strategy execution.
Thank you. To conclude, in the drilling and workover, we remain firmly focused on delivering the 8 new build rigs for BDO. With this, we will reach, مثل ما ذكرنا سابقا, alhamdulillah, 100% utilization for all our fleet, and we'll have no stack rigs. In the well services, we are pleased with BDO fracturing award. This is one of the contract that we were waiting for a long time. This will allow us to get into more complex high-end operation. In terms of international growth, we continue the discussion with Sonatrach in Nigeria, and we also having a discussion with NOC from Libya. With that, we conclude our presentation, and we are ready for any Q&A. شكرا جزيلا. احنا خلصنا تقريبا البرزنتيشن. اذا في اي استفسار ولا اي سؤال، نحن سعداء جدا باخذ استفساراتكم واسئلتكم.
So we'll go for the Q&A session. You can raise your hand for the question, and we will unmute you. Ali bin Rene.
You can also
you can start.
Yeah, read the question. So
There you go.
Hello?
Hello?
Can you hear me?
Yes, we can hear you. You can go ahead.
Okay, thanks. Thank you for the call and the presentation and the opportunity to ask questions. I was wondering, the guidance on revenue, does it include, because it was unchanged, I guess, does it include the latest contract that you won, which is around 24 million per year, starting Q2, I think, or Q3?
Okay, Robert, can you just take that?
yeah, I'll take the question. Thank you for the question. So the thing is that, I mean, so we just signed the contract, and those contracts are on call basis, right? So we don't really know the volume or the timing of when the contract will be executed. So we haven't included because we think it's a bit too early to see what's going to be the contribution. We also have a little bit of upgrade to be made on the second frac fleets, which includes different type of equipment. You have the pump, you have the sand management system, you have the coil tubing, etc. So we believe that the contribution on that particular contract will only kick in by the end of the year. So at this point in time, we have decided to leave it unchanged, but we might revise it at the end of Q2. We'll see.
Okay. And on that contract, do you require any leverage for this specific contract? And what is the margin expectation on this contract?
So we can't really comment specifically on the margin of a contract, but what I will say is that overall we think it's going to be accretive to the business because some of the equipment is already here, and all it's going to do is basically improve the utilization of existing assets. Some asset will have to acquire. Other assets are already existing, and any improvement of those assets, any improved utilization, will definitely be accretive to the business.
I would like to highlight one thing. The truck business is a call-off business. So we, as Robert mentioned, we do have majority of the equipment with us, and the utilization rate with this contract going to improve. So all in all, definitely we're going to see an improvement. We will wait until we start the operation by beginning of Q4, and then we can have a better picture and reflect the upside.
Mr. Shao, you can go ahead. Yeah, Mr. Shao, you can go ahead. Unmute yourself. You can talk. We can go to the next one.
Let's go to the next question.
Hello, good afternoon. Am I audible?
Good afternoon. Yes, good afternoon. We can hear you.
Okay. Thank you for your presentation. I have just a few questions. One is that you mentioned that you're targeting 100% utilization by third quarter. Yet, when I look at the revenue guidance, it remains between 140 million to 150, which is almost the same as when the utilization was in the mid-80s. So, does that imply the day rates on the new contracts are lower, or are you building a significant, buffer for a potential downturn operation?
No, I don't think. No, the day rate are not necessarily low. It's just the revenue guidance is just reflecting the timing of when we believe the rigs are going to be contributing. I mean, for instance, on the new build delivery, which is the PDO Wave 3 rigs, so we have 6 rigs to deliver, and the first 2 rigs are expected to come, sometime in Q3, end of Q3, early Q4. So we will only have a partial contribution in 2026. So it's not about the day rates. It's just about when we believe that those rigs will come online and when we believe they're going to contribute. So that's the reason. You want to add something?
No, you're absolutely right. The day rate, there is no significant change on the day rate. It's only the timing when the rigs will arrive to the country and when we will commission them and starting the operation.
Yeah, I think we still have a lot of moving parts in terms of those deliveries. So maybe we'll wait until Q2 to see how we can if and when we revise the revenue guidance. But no impact on the day rates.
Okay, understood.
Sorry, did you have another question?
Yes, I have one more question. One more question regarding the discussions in markets like Algeria and Libya. These markets, they carry significantly higher payment and the current geopolitical scenario. Is there any current existing idle assets, and would they require any new capex cycle?
We are in a very early stage of discussion. If it happened that we will have a standalone business cases, we are exploring different options. We are also assessing the situations. We will take all the surrounding in our consideration. We will not go without assessing the whole situation. So to bring confidence to the investors, it's a high-level discussion at this stage. There will be a full risk assessment into whether we are going with a new machine or we are going with the old machine, and what are the confident on the table that we enter those countries. Algeria, we believe we have very good chance. It's a stable. A lot of big NOCs, big international companies are there. Libya, we are in a very early stage.
Okay, thank you.
So yeah, let's move on to Nureddin. I think Nureddin, you have a question.
Yes, thank you so much for the presentation and for the clear guidance. Just a couple of questions for me. If you can share, please, some color on the 3 rigs to be retired. Should we expect it to be sold, or should we expect some recycling there? Then I'll get to the next questions. If we can take it one by one, please.
Yeah, we have more than one option for those rigs. As we are speaking, and this is again, this is not sort of a solid commitment. We are already negotiating a contract with the different operators in Oman. They're going to come out of PDO, and we already start a dialogue with a different operator within the country.
Amazing. And can you give us an update on the tendering activity in Oman? Given that there is limited exposure to the Strait of Hormuz, should we expect higher production across Oman and hence stronger tendering activity?
I think that there is no particular change in the production. I think that I mean, obviously, the geopolitical situation means that Oman has a good opportunity to try to export and produce more. Saying so, it's a small market. There is only I mean, I think there is only like 80 rigs total rig count in the country.
Yeah.
So I mean, the spare capacity, the possibility of increasing the spare capacity, I think are quite limited. But obviously, because we are the largest drilling contractor in the country, we're very well positioned. And what Zaran is saying is that, with respect to those 3 rigs that we expected to retire, now we're seeing interest from some of the clients to have those rigs continuing. So maybe it's an opportunity for us to keep those rigs working for a couple of years.
Indeed. In fact, that in the last couple of weeks we've been approached by different operators for additional rigs, which, as we mentioned earlier, by end of Q2 we will be deploying all our stacked rigs. So we don't see any decline in the activities. It is going to be only stable, if not increasing a little bit.
Great to hear. Thank you. My last question on Kuwait. Can you give us an update on the situation of the standby rigs, or if there could be further rigs to be on standby?
Yeah. So we have, as we are speaking, we have 3 rigs in Kuwait. 2 are in operation since last year, and since 5th of March they've been stacked on with a rate. It's 90% of the day rate, and we were hoping the situation will get better and we go back to operation. However, until date, the client is requesting to keep them on a standby underpayment until further notice. The 3rd rig is under commissioning, and we expect the rigs to finish the commissioning by end of this week, beginning of next week. And for that, we also think the client already initiated the discussion to keep the rig under standby with payment.
Amazing. Thank you so much.
If I can just add, just to make sure. So the standby that we have on the 2 rigs working in Kuwait, it's 90% of the day rate, right? So it's not a huge shortfall compared to compared to the day rate, right? The only thing is that you have also there is a little bit of revenue loss on the associated revenue, which is, your regular client recharge, your catering recharge, your rig move, etc. So all that creates a little bit of an impact, but it's not that material. It's only 2 rigs, and it's only 90% of the day rates.
Very clear. Thank you so much.
Thank you, Nadeem. We move to Sh.م.ع.ع. Hi. Good afternoon, Sh.م.ع.ع. You can hear us? You can go ahead with your question. Mr. Sh.м.ع.ع. from Vision Capital. Okay. We can move to
George Matthew.
George Matthew. Joyce.
Hello, good afternoon, gentlemen. Can you hear me?
Yes, we can hear you.
Well, thank you for the presentation. Just a few follow-up questions. First one on the previous question of your Kuwait operations. What are the reasons for keeping these rigs in stack condition? Is it because of the current volatile geopolitical situation or any other reasons?
For that reason, yes.
I think it has to do with storage, right? Storage capacity or...
It's under hot stacking.
Yeah.
So the rig is stacked, both rigs are stacked with crew. The machine operated bare minimum to keep the rigs warm, so we can reactivate the machine at any point of time. But we've been instructed by the to keep them on a standby until further notice, and as Robert and I mentioned earlier, under 90% of the day rate.
All right. So did your operations in any way, any of the rigs were affected during the last 2 months because of the situation? No. In Kuwait?
No, not at all. Besides this, they are stacked. There is no any harm to the equipment or any harm to the people.
Yeah. Yeah, we have. I mean, so it's only for Kuwait, and it's only for 2 rigs. I mean, as far as Oman is concerned, the rest of the operation, there is absolutely no change because of what happened in the last 2 weeks or 2 months in the Gulf.
Right, got it. And you mentioned that you're planning for deployment of 8 new rigs. Could you please give us a possible timeline for this?
And see the 6 rigs with BDO, the wave 3 of them, they will come to the country by end of Q3, beginning of Q4. Hopefully, we don't see any impact on delivery as of today. The rest, the 2 of them will come next year, somewhere Q2 27, and the last one for BDO will come beginning of Q8, 28. One of the additional rigs will come by January next year. So those are the 7 rigs with BDO. The 8th rig is what I just mentioned. It's already in Kuwait. It's under commissioning, and it should start the operation, hopefully, if everything goes well, by beginning of next week. Otherwise, they will also hot stack it. So all of them, they will be deployed between Q3, Q4 this year, and the last one will be beginning of Q1 2028.
All right, got it. And my last question is on your scheduled maintenance activities for the rest of the year. Could you please give us some color on what are the scheduled maintenance activities? Just and also just wanted to check if there is any major Cat 4 maintenance activities coming up.
It is actually Cat 4 maintenance. This is a 2,000 horsepower rig. It's a big machine. It's been operating for BDO for the last 10 years, and it is due for Cat 4. So we took the machine out of the surface, and we done a full Cat 4 on it. We finish it within 60 days. That's the window we were planning for, and we finish it within that window.
So there is only one for Cat 4. Is that
yes,
right?
one was done last.
Okay.
Yes, one was
so
last year.
When are you planning to do that?
Okay, one was done. Those are 3 rigs. One was done last year. One was done beginning of Q1, and one is ongoing as of today. It will finish within 3 weeks.
Got it. And there are no other major maintenance activities for the second half of the year?
No, second half of the year, we don't have anything for Cat 4.
Got it. Thank you very much. All the best.
Can you go to the chat box?
Yeah. I think I'll read some of the questions that we didn't cover during the Q&A session. So the question is, the notice mentioned in the third Kuwait rig is expected to commence drilling in Q2 2026 and is a final stage of client acceptance. Has this rig formally been accepted, and what is the time frame for contract value tuner with Wafra joint operations?
Yeah, the rig not yet accepted. It's under endurance test as we are speaking, and it should be accepted within a couple of days, hopefully by beginning of next week. The plan, we already initiated a discussion with the customer. They wanted to hot stack it with a certain rate until the situation more safe for them to go back to operation.
Then again, with a similar question, you mentioned 3 stack rigs by the end of Q1 2026. Does that include the Kuwait rigs? Could you also clarify when did the rig 306, the one with a contract by the end of 2025, get any contract? Which contract includes this rig? Which contract includes this rig?
We said three inactive rigs. Out of the inactive rigs by the end of Q1, one of those rigs is the one that we're starting in Kuwait right now. So this is the one that Zaran mentioned that we expect to start anytime soon. Out of the two other rigs, one actually started last week.
Yes.
With PDO. So that rig is now working. And the third rig out of the 3 is rig 306, which was mentioned, which is going to be used as a gap filler. And we expect, so this rig is being mobilized, and we expect this rig to start drilling, drilling operation 6 to 8 weeks from now. So we expect that this rig will be in Q3. This is why Zaran mentioned earlier in the call that by the time we get to Q3, we expect that we're going to have a full utilization on our fleets. I hope I answered. Yeah.
So we move to the next question. The company is nearing the peak of the capex cycle. What is the expected 2026 and 2027 capex?
Yeah, so as we mentioned, I mean, both 2026 and 2027 are heavily loaded in terms of capex because of the growth plan. As I said in the guidance, we said about 70 to 90 million for the year, which is quite significant. In 2027, as Zaran mentioned, we still have to deliver a couple of rigs. So 2027 will be loaded in capex, but not as much as 26. So we see the peak in 26. We see the peak particularly in H2 of 2026. But yeah, 2026 and 2027 are the 2 big years in terms of capex because of the delivery of the 8 new builds.
So one more question. What is the current average day rate for the onshore and workover drilling? Do you expect this rate to raise next year?
We don't expect the day rate to increase next year. We can't forecast that. The average day rate will vary because of the size of the rigs, the capex of each rigs. So it's somewhere between $23,000 to $28,000 per day.
I think Mr. Shah is having some problem with the system, so he wrote his question.
Yeah.
Could you break the 70-90 million capex between new rigs and maintenance, new deployments? The PDO contract, is it at new or at a replacement of an existing contract that is expiring?
Okay. So on the capex, I mean, 80% of the guidance that we gave relates to new rigs, and roughly 20% is just sustaining capex, which is the usual recertification on your well control equipment and other critical equipment that you have to do. The PDO contract, so when you mentioned the PDO contract, I'm not sure whether you mentioned the PDO contract that we announced in Q1 or the one for the frac. I assume that because it's related to the rig, it's related to the one that we announced in Q1. So the PDO contract that we announced in Q1, we announced extension or new contract award for 4 rigs with 6-year each rig. And this is the continuation of, it's a continuation of what we call the Wave 2, which is rigs that were working for PDO. So it's just existing asset working for PDO and PDO has extended with new 6-year firm term contracts for 4 of those rigs.
One more question from Shaul. Could you please explain the difference between rig moves and rig activity?
So this is very important. So when we are drilling, we are on day rates, right? So we receive a day rate for every 24 hours that we're drilling. When we are moving the rigs from location A to location B, we are on lump sum, which is a completely different business model, which means that it is particularly important for us to be extremely efficient on how quickly and safely we can move the rig from location A to location B. And as Zaran has mentioned, one of the key enablers for us and one of the things that we're very good at is moving the rigs, because we always beat the target in terms of moving the rig. So the quicker you move the rig from A to B, you get the same lump sum amount, but then you're back on the day rates quicker, right? So that generates additional revenue. On the other side, if you take 10 days or 2 weeks to move the rigs, you're going to get paid the same amount as if you take only 3 days, right? So this is why we insist on the efficiency of the rig move, because this is a key enabler for us.
We'll go back to the Mr. Rabi. Yeah, Mr. Rabi, you can go ahead with your question.
Hi. Am I audible?
Yes, we can hear you.
Yeah, thank you for the call, and thank you for taking the chat questions. I just had one follow-up on the three stacked rigs in Kuwait. So these rigs are currently at 90% day rates, the 3 of them?
Two of them are at 90% day rate. Those 2 are been in operation for the last 1.5 years. The third one, it's a rig under commissioning. Commissioning means it's under client acceptance. We are in a very final stage, and it is not on the day rate yet at this stage. So once they accept it within the next week, hopefully, we will convert it into a standby rate. And that's discussion already initiated with the customer.
Okay, and okay, so this standby rate is a normal day rate.
Yes, it is basically a normal day rate minus, i.e., it is in this particular contract the 90% of that day rate.
It's quite. In the drilling contract, it's quite customary that you have different type of rate. You have your day rate, full day rate, and then you have a reduced day rate. Maybe you have waiting on weather, you have waiting on the client, you have standby, you have different type of rates. So this one is just 90% day rate, which is standby with crew.
Okay, thank you.
We have one more question from Mr. Mohammed Fadl from the chat. Is rig 306 filling the gap for the newly built associated with the PDO contract announced in December?
Yes.
We are done with the all chat questions. Any more questions from the team on the call?
The question.
Shaul is, okay. So, Mr. Shaul, thank you. My understanding is a new rig cost around 10 to 11 million Omani Riyal. So 80% is 50 to 70 million Omani Riyal capex this year. Does that mean Abraj will have 5 to 6 new rigs this year? If there is a replacement, what happens to the old rigs? What are being replaced?
Okay, I will answer the very last end. The 6 Wave 3 rigs, 3 of them are replacement rigs for our existing. And as I mentioned earlier, we already start having discussion and dialogue with different operators in Oman that they would like to have a proposal for those 3 rigs. So we are trying to find a home for those replaced rigs. Those are around 20 years old machine, but they are kept in a very good shape and they are very marketable. So that discussion already ongoing.
And with respect to the number of rigs, I mean, we can say that, between Q1 now, 2026 and Q1 2027, yes, there will be 5 to 6 new rigs. There will be six new rigs delivered. Actually, it's more 6 to 7 than 5 to 6. Yes.
It's a milestone of payments.
Sorry,
There's milestone of payments.
yeah. I mean, the thing is that the timing of the cash outflow on the capex is slightly different than the timing of the delivery of the rigs. But the assessment is correct. Yeah, between now, in the next 12 months, we will deliver 6 to 7 new rigs, including the one that we are delivering as we speak in Kuwait right now.
One more question. For 2027, how much are you expecting in capex?
So it will be slightly reduced than 2026, but again we'll have the tail end of the delivery of the PDO Wave 3, and then we have another rigs that we need to deliver in, as Zaran mentioned, in Q1 of 2028. So this capex program was still kicking on. So we don't have a range at this point now, but it will be less than what we're spending in 2026. 2026 is the peak year for us in terms of capex investments.
Any more questions in the chat or on the call? So again, from Shao, he's commenting. So the net capex is expected to be less than guidance capex, assuming the oil rigs generate something. Could you please give us an estimate of the net capex this year, if possible?
I'm not sure. I'm not sure I understand the net capex. So as we said, so capex this year we estimate between 70 to 90 million Omani riyal, right? And this is a peak year. I'm not sure if Sh.م.ع.ع can specify what exactly is the net capex. I think net capex is capex less asset disposal. I mean, as long as so we have 3 rigs that, as far as I've been here only for 3 months, but he will correct me if I'm wrong. But as far as I know, I mean, there were 3 rigs that we intended to retire this year and have them replaced by the PDO Wave 3 rigs. Now, because of what Zaran said and because of the geopolitical situation, we're seeing an increased demand from operators for rigs. So there might be a chance that those 3 rigs will actually continue working throughout 2026 as opposed to being retired. So if the question is net capex, the guidance capex net of the asset divestitures, maybe we're not going to do asset divestitures, but we'll keep generating revenue and cash with those 3 engines, with those 3 rigs, correct?
Correct. Yeah. Maybe just to add here, Shao, I mean, these 3 rigs are very well maintained, and we ensure that the maintenance is up to the level. That's why we do the CAT 4 on time. So they're in good condition and they're operational. It's just some of the customers, they prefer to have not more than 20 or 25 years old rigs. But across out of Oman, some of the rigs are more than 40 years, and still they're operating in good conditions. More of how you do the maintenance and take care of these assets.
Yeah, if there is a business case for us to continue operating those 3 rigs, I mean, as Sadiq said, the 3 rigs are well maintained. If there is a business case for us to continue operate those 3 rigs, we will continue operate them. So the guidance on the capex is not net capex. This is pure spending, regardless of whether or not we divest other assets.
Any more questions from the call or from the chat? I think that with that we will conclude the call, and I would like to thank you all for your time and active participation in the session, and hope to see you soon in our coming earnings call. Thank you. نشكركم على حسن استماعكم، ونتمنى نتلاقى معكم ونتواصل معكم في القريب العاجل إن شاء الله. شكرا
جزيلا لكم جميعا.
Thank you.